So this is the second part of the 2-video series, the Wheel Strategy Challenge that I'm doing right now. If you haven't been watching the first video of this 2-video series, I highly suggest you to start watching it first before watching this video, because otherwise it's not really going to make sense. So don't hesitate to go watch it first and then jump into this video. So as I said, the goal of this 2-video series is to share my thought process when using the Wheel Strategy. So in the last video, I have chosen the stock that we were going to use for the Wheel Strategy. And in this video, I'm going to go over which expiration I like to use and why, and explain the differences between different expirations, and also why I have some preferences around some strikes and not some others. So we're going to cover all of this in this video, so get ready, take a coffee or something, and let's get started. But before diving into this video, I have really something important. If you find this video interesting, or you watched the first part of this 2-video series and now you're watching the second one and you actually like it and you find that cool, then don't hesitate to, drop a like on this video and let me know in the comment section that that's something that you actually like. That lets me know that you appreciate this type of videos and that I should do more videos like those ones. By the way, the link of the first video of the first part of this series will be in the description, so don't hesitate to go into the description and watch the first part if you haven't already. Alright, so now we are in the Testworks platform, and in the last video where I was sharing, for example, how I choose the stocks, what are the different criteria that I like to use. Once we have chosen the stock for the Wheel Strategy, we have then to choose the expiration, because as you can see, I have chosen the stock FCX in the Testworks platform, and now you can see that I have plenty of different expirations in front of me. So which one should I choose for the Wheel Strategy? Well, usually when I go for the Wheel Strategy, I like to go for closer dated expiration, and there are several reasons for that. When you go for closer dated expiration, you're going to experience what we call a bigger gamma. And gamma is the Greek letter, and that's the sensitivity of delta. So right now, I know that it's going to sound complicated, but stay with me, it's going to be clear. When the stock moves, it's going to affect the option price. For this, we all agree on that. Well, depending on how close or how far the expiration that you're going to choose, well, the stock is going to more or less influence the option price. And typically, the further away the expiration, the less impacted the option price is going to be by the stock moving. And the closer dated the expiration, the more it's going to be affected by the stock's movement. And usually, it quite sucks when you are a really shorter dated expiration, you're using those very closer dated expiration, and you have the stock moving a lot, it's going to affect your P&L like a lot. However, in the case of the Wheel Strategy, I think that's not necessarily a bad thing, because remember, when you use the Wheel Strategy, there are basically two outcomes possible when you, for example, either selling a put or selling a call. Either the put expires worthless, and in that case you keep the full premium, or the put expires in the money, and in that case, or the put or the call, by the way, and in that case you get assigned and you have, for example, to buy 100 shares of the stock if you got assigned on your put. If you got assigned on your call, you have to short 100 shares of the stock. And because we have such fixed rules, because we know both outcomes, and the P&L until expiration is not really a problem when you use the Wheel Strategy, because what you're focusing on is the option going to expire at the money or in the money? You don't really mind about what's in between. So because of that, I don't really mind going for closer dated expiration. And for example, if we are in the case of FCX, I would be tempted, for example, to try to go for the July 2nd expiration and see if there is enough liquidity, if there is enough premium, so I can, for example, sell an option. So that was for the expiration. And as you saw, I chose the July 2nd expiration that is expiring in 13 days. After that, nothing prevents you to go for a longer dated expiration. And the thing that you have to know is the differences in terms of the Greeks between a closer dated expiration and the longer dated expiration. As I said, the closer dated the expiration, the higher the volatility in your P&L, because the more the option price is going to be dependent on the stock's movements, compared to a very longer dated expiration where the stock is going to impact less the option price, and it's more going to be the volatility that is going to impact the option price. And those are differences between shorter dated and longer dated expirations. And personally, I usually like to go for expirations that are around 40-45 days to expiration. But when it comes to the Wheel Strategy, as I said, as we have such fixed rules and I'm just focusing on either my option is expiring out the money or either it is expiring in the money, because of that, I'm going to go for a shorter dated expiration because I don't mind the volatility of the P&L and I don't mind having a bigger gamma. So in that case, once we have chosen the expiration, we have to choose the strike for that. We need to start the first step of the wheel strategy, which is selling a put. So first thing, we need to look at the put section. So on Tastyworks, it's going to be on the right. So you see that you have all of the different strikes. And when we look at the different puts that you have, for example, on the right column, you see that we have this column open interest. And if you remember what I said in the first video of this wheel strategy challenge, the higher the open interest, the more liquid the option is, and the easier for you it is going to be to enter and exit your position with your profits, hopefully. And the thing is, what you can see here is that for the out the money put, there is very few open interest. There are very few contracts currently being held right now. Meaning that if I, for example, sell an option, let's say at the 32 strike, where there are only 26 contracts currently being held right now in the open interest column, well, it's going to be quite a pain to try to buy back my option later down the line. I might run into some liquidity issues. So what should I do now? Should I still take the trade, or should I try to go for a later expiration, maybe to try to find more liquidity? Well, what I usually do, and to be completely transparent, even though I like to go for closer dated expiration for the wheel strategy, if I see that I don't have any liquidity in, like for example in that case where I really don't have much liquidity, I'm going to try to go for the next expiration to see if there is more liquidity over there. So if we, for example, close that expiration that we saw was liquid and we try the July 9th expiration, is it better? Well, we see that it's actually a bit better. You see that for some strike like the 31 strike, we have more open interest, but usually you see that it's actually quite the same for the in-between strikes. For the 32 to 33.5, you see that we have very low open interest. So what if we try once again the expiration after the July 16, that is 27 days to expiration? Now we see that we have a lot more liquidity when it comes to each and every single strike. You see that there is thousands and thousands of contracts currently held right now. And that's what I meant in the first video. I mentioned that weekly options tend to be less liquid than monthly options, and that's actually quite a good example of it. Usually weekly options are going to tend to have less liquidity. It doesn't mean that you shouldn't trade them at all, but if I see a weekly option with lots of liquidity and I want to use the wheel strategy, I'll probably go for it. Otherwise, I'm going to maybe go for a monthly expiration so as to have more liquidity, so later down the line I'm not in trouble trying to exit my trade with my profits. So now that we have chosen the right expiration and there is enough liquidity, let's talk about which strike I'm going to choose. So when you start the first step of the wheel strategy, which is selling a put, I'm usually going to focus on the 30 delta strike. So what does that mean, the 30 delta strike? Well, each strike of the stock can basically be associated to the delta, and usually we talk about strikes in deltas because it's a quick way to refer and everyone knows what you're going to talk about when you're talking about the 30 delta. And the reason for that is that the delta can roughly be associated to the probability of expiring in the money. Meaning that if you sell a put that is at the 30 delta, then in that case, that put that you sold at the 30 delta roughly has 30% probability of expiring in the money. You see, 30 delta, 30% probability of expiring in the money. And because it has 30% probability of expiring in the money, then it has 70% probability of expiring out the money. You know, that's normal. That's the opposite. If you have 30% chance expiring in the money, then you have 70% chance expiring out the money. And the reason why I like to go for this type of strikes around the 30 delta is that I find that there is the best premiums in general in terms of risk rewards. I find that the 30-35 delta offers some good probability of seeing the option expiring out the money, and me so being able after that to sell another option and making more money. And I see that there is a good balance between the probability of profit and the money that I'm making. You know, that's a balance that I found quite nice. So if we, for example, look at FCX and we try to find what is the 30-35 delta, you see that in this column you have what we call the deltas, and all the deltas that are less than 50, for example 41, 43, as you can see, 26, all of these are for options that are at the money. You can see that there is actually a small thing with a small arrow which says that below that all of this here is in the money and all of this is out the money. And me, I'm going to focus on the out the money strikes. And following what I was saying before, I'm going, for example, to go for the 33 strike. It has a delta of 33, as you can see, which goes between the 30 delta and 35 delta, and that's usually what I'm going to go for. if I sell it, if I click on the bid, meaning that I'm going to sell that option, I'm going to collect a credit of $1.05. And now you see that I have some stuff that appeared below. So if we look at that line, well, you see that there are several information. If I just change colors so it's clear, you see that I have a pop. The pop is the probability of profit at expiration. I have a 68% probability of profit at expiration. If we look next to that, there is a P50, which shows 84%. The P50 is the probability of profit at 50% profit target, meaning that my max profit is of $105. Well, if you take 50% of that, I have around 84% probability of reaching a profit of 50%, meaning around $77, $78, 50% of $105. So you see that you have quite a lot of information actually. You can know quite a lot of things even before entering the trade. So that's actually quite useful to always base yourself looking at the probability of profit, looking at the credit that you receive. And something that is very, very important to mention, and I really want to mention that, if you try to sell an option and you see that the profit that you're going to make is really, really small, it might not be worth actually taking the trade. And the reason for that is that if you actually start selling an option and you start using the wheel strategy, you want to get paid for the risk that you're taking. You want to actually be fairly paid. And what I found is that usually if you have, for example, a credit of around $1 for the 30-35 delta for a stock that is around $35 like FCX, that's usually a good risk reward. Like you're getting fairly paid. And the reason for that is that FCX just went down before, and usually when a stock goes down, the implied volatility is going to rise, making options more expensive. So it's going to be more juicy and there's going to be more premium, allowing you to make, as an option seller, more profit. Hence why that was a long explanation, but basically to choose the strike, I like to stick between the 30-35 delta. I like to also collect at least $1 of credit if possible. And in terms of probability of profit, it's usually going to correspond to 70% probability of profit usually. It can of course change. You see here it's 68% probability of profit, but that's usually it. So basically when I'm going to sell that option, if I click, for example, review and send, and after that I send order, well, in that case, if my trade gets filled, I'm going to collect a credit of $1.05. And after that, there's going to be two outcomes possible. Either my put expires at the money, and in that case, I just keep selling another put and I collect once again a credit and I make again a profit, or my put expires in the money, and in that case, then I'm going to have to buy 100 shares at the strike, and in our case, the strike is at this 33 strike, as you can see. So that means that if my put expires in the money, I have to buy 100 shares of FCX at the strike price of $33 per share, which would mean that I would need to put on the table $3,300 so as to buy 100 shares of FCX. So now we are really at the point where you can actually start sending your order and start trading the wheel strategy. And obviously there are some other steps after that you could do, and I will definitely explain you more about this and show you more how to roll a trade, how to do this type of things. But those two videos were really there to show you how I actually choose a stock, how I choose the expiration, how I choose the strike, so you can start doing it also for yourself if you didn't know how to use the wheel strategy. I hope this 2-video series was insightful and it was useful and you actually learned some stuff on, for example, how the wheel strategy works, how I choose my stocks for the wheel strategy, how I choose the expiration, what are the differences between the different expirations, how I choose the strikes. I hope it was useful for you. If you have any questions, please don't hesitate to comment it below. I'll be happy to answer any questions that you might have. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.